And I'm Mira.
So it's Monday evening, May 25th, 2026. I mean, what a weekend, right?
Yeah, seriously. It's been a lot to process.
Totally. Because, you unplug for a holiday weekend, you're hoping to finally enjoy a Sunday barbecue, and then your phone just starts lighting up with these massive headlines.
Right, like a historic peace deal, but then also, unexplained explosions at the exact same time.
Exactly. It's just wild whiplash. So our mission for this deep dive is to basically provide you with a full holiday market news recap. We want to help you cut through all that noise, figure out what happened over the long weekend, and equip you with the macro backdrop you actually need to navigate the coming week.
And just really quickly, right off the top, a quick reminder for everyone listening. This deep dive is strictly for market context and discussion, educational purposes. It is not personal investment advice or an investment recommendation.
Right, perfectly stated. So we've got a lot of ground to cover. We're going to break today's show into 3 core sessions, and then we'll cap it off with our bonus paper trading segment. So let's just dive right into the first session. How did market movements shape up over the past week?
Okay, so if we look at the trading week that ended on Friday, May 22nd, the defining characteristic was, it was this localized volatility that ultimately just gave way to a really powerful bid.
Yeah, that rally was intense.
It was. I mean, early on, the S&P 500 dipped down to a Tuesday close of 7,353.61. So it looked pretty rocky.
Definitely.
But then buyers just aggressively stepped in. The index rallied hard and finished the week all the way up at 7,473.47.
And what's wild to me is how that relief rally just completely crushed volatility.
Yeah.
Like the VIX, the fear gauge, it dragged down from 18.06 all the way to 16.70.
Yeah, a massive crush.
Which, given the geopolitical overhang all week, it felt a little disconnected, right?
Well, yeah, but you have to look at the bond market. We had a nice tailwind from treasuries. The 10-year treasury yield marginally cooled off. It dropped from 4.623% down to 4.558%.
Right, and that acts as a huge relief valve for equities.
Exactly. But look, the most headline-worthy price action of the entire week, by far, was the violent collapse in the commodity complex.
Oh, absolutely. Crude oil just fell off a cliff.
Yeah, WTI plunged from 108.66 all the way down to 96.87.
A completely massive drop. And gold steadily bled lower, too, closing at 4,509.20.
Right. But interestingly, through all of that, the credit markets showed some really solid resilience. High-yield bonds, the HYG ETF, actually climbed up to 79.91.
That's a great sign for corporate health, honestly. No panic there.
No panic at all. Meanwhile, the U.S. dollar index, the DXY, it just ground steadily higher, up to 99.32.
Okay, so just to wrap up this first part, the one was really characterized by equity resilience, right?
Yeah.
And that was fundamentally driven by that collapsing oil price and those cooling treasury yields.
Exactly.
All right, so we're going to take a really short break, and we'll dive into those wild holiday weekend headlines.
Okay, we're back. Let's get right into it. What were the key news events over the holiday? And what are their market implications under our contemporary macro context?
So real quick, before we hit the weekend news, we should establish the baseline heading into tomorrow, because today is Memorial Day here in the U.S., so cash equities and treasuries are closed.
Right, which means liquidity is going to be incredibly thin going into Tuesday morning.
Exactly. And tomorrow's data docket is pretty heavy. We've got the Chicago Fed National Activity Index dropping at 12:30 p.m. Eastern Time. Then the Case-Shiller home price releases follow right at 1 p.m. Eastern.
Okay.
And then consumer confidence is out at 2 p.m. Eastern Time. And bill auctions wrap up at 3:30 p.m. Eastern Time.
Got it. So let's talk about the weekend. Because the major catalyst driving that massive drop in oil we just talked about was this huge diplomatic breakthrough.
The Strait of Hormuz, right?
Yes. Delegations from the U.S., Qatar, and Iran are reportedly nearing a 14-point memorandum of understanding to end the war and reopen the Strait of Hormuz within a 30-day window.
Wow. 30 days to reopen the most critical energy choke point on the planet.
Yeah, it's huge. And the diplomatic trade-offs are pretty significant. The U.S. essentially drops its naval blockade and eases oil sanctions, and in return, Iran allegedly agrees to transfer its highly enriched uranium to China.
And just to keep the facts completely neutral here, this whole negotiation is being brokered by Pakistani and Qatari officials working directly alongside President Trump.
Right. It's a massive deal. But, and here's where things get really complicated, just as peace seemed imminent, we hit this harsh reality check on the wires.
Get explosions.
Exactly. Unexplained explosions erupted in Iran's Bandar Abbas and on Qushm. And simultaneously, Israel explicitly ended its containment strategy and struck over 70 Hezbollah targets in Lebanon.
It's just wild. I mean, it feels like this unpredictable natural disaster of geopolitics just blowing up the peace deal out of nowhere.
Well, I'd actually challenge that reflex a bit. If you look at it through a game theoretic lens, sudden strikes right before a major peace summit are rarely random. They're deliberate leverage play.
Oh, like trying to maximize their bargaining power right before the ink dries.
Exactly. We always talk about geopolitical brinkmanship as an unhedgeable tail risk, and this is a textbook example. You just can't model for a sudden explosion.
Right. And while all this energy chaos is happening, it ties directly back into monetary policy. Because we also got the news that the Senate confirmed Kevin Warsh as the new Fed chair.
Right. A major shift there.
Yeah. And immediately, Fed Governor Christopher Waller delivered this decidedly hawkish pivot. He actually went on record calling it, quote, crazy to discuss rate cuts right now given the recent data.
And that's not just a U.S. thing. There's a global parallel here. The ECB's Sternaras explicitly warned about secondary inflation effects coming from these exact supply chain bottlenecks.
Signaling they're ready for restrictive rates, too.
Exactly. It perfectly reinforces the idea of discount rates as financial gravity. When central banks threaten to keep rates high, it just pulls down the present value of all future earnings.
And we are already seeing that gravity crush the consumer.
Yeah.
I mean, look at that dire U.S. consumer sentiment print. It cratered to an abysmal 44.8.
Yeah, 44.8 is bleak.
It perfectly illustrates energy shocks as a delayed consumer tax. By the time that high oil price hits the gas pump, the consumer has nothing left over for anything else.
Totally. So you have sticky inflation, hawkish central banks, an exhausted consumer, and geopolitical chaos. But there is one massive force fighting all of this macro gravity.
The CapEx cycle.
Exactly. The massive ongoing $700 billion infrastructure build-out by the hyperscalers.
And we got so many weekend validations for this. NVIDIA CEO Jensen Huang was out in Taiwan promoting the Vera Rubin architecture. AMD CEO Lisa Su was confirming unyielding demand.
Right, which pushed Taiwanese equities to record peaks.
It really is AI CapEx as a cycle-agnostic arms race. They just don't care about the macro gravity. They have to build these data centers.
They do, but there are physical constraints to all this growth. Just look at Japan over the weekend. They had to announce an emergency 3 trillion yen energy subsidy just to survive the oil shock. And even crazier, they announced a drastic pivot to 70% nuclear power. It perfectly demonstrates energy access as the bottleneck for AI. You can't run these massive data centers without immense stable power.
So just to summarize this session, we're basically looking at a massive tug of war. You've got AI CapEx acting as this market shield, but it's fighting against the twin threats of sticky inflation and all this geopolitical chaos.
Exactly. That is the macro landscape right now. Let's take another quick break and then we'll look ahead to the upcoming calendar. Welcome back. Let's jump into our final main question. What should we watch in the coming week? Okay, so outlining the incoming data based on the holiday recap, tomorrow, Tuesday, May 26th, is when that Memorial Day delayed data batch arrives.
Right.
We're going to see the Conference Board consumer confidence, the Case-Shiller home prices, the Chicago Fed National Activity Index, and Dallas Fed manufacturing.
Okay, what about Wednesday?
Wednesday, May 27th, you'll want to listen for Fed Governor Lisa Cook's speech. It's titled AI, the Economy, and the Financial System. And we also have a 5-year Treasury note auction that day.
And Thursday's a really big one, right?
Yeah, Thursday, May 28th is a massive macro day. We get April PCE and core PCE.
The Fed's favorite inflation metric.
Exactly. Plus, the Q1 GDP second estimate, durable goods, personal income and spending, weekly jobless claims, and new home sales. It's a heavy day today.
Wow. Okay, and Friday.
Friday, May 29th, look out for the advanced goods trade balance, the Chicago PMI, speeches by the Fed's Bowman and Paulson, and a 7-year Treasury note auction.
Got it. And just peeking into next week.
Looking ahead to Monday, June 1st, the ISM manufacturing PMI and its sub-indices will drop, alongside factory orders and construction spending.
Awesome. You know, it was the kind of weekend where you finally unplug to enjoy a Sunday barbecue, only to get alerts that a historic Middle East peace deal and a new string of unexplained Gulf explosions are somehow happening at the exact same time. But hey, at least hyperscalers are spending another $700 billion on AI infrastructure, meaning your tech portfolio might just survive the macro apocalypse. Drink some water, double-check your stop losses, and brace yourselves for Tuesday's opening bell.
Seriously. So with that baseline set, let's move right into our bonus session, paper trading.
Yes. So for anyone new, this is our public paper trading experiment. We designed this to basically test if our daily news analysis actually generates alpha.
Right. Does this actually work in practice?
Exactly. And so far, our current portfolio value is at $10,993.81. Our portfolio return stands at 9.94%, which is comfortably outperforming the S&P 500's return of 4.88% over the same period.
Not bad at all.
No, I'll take it. Okay, so I'll go first with my trade decisions. For Tuesday's close, I am going to sell $1,000 of XLK, which is the tech ETF. And I'm going to buy $1,000 of XLE, the energy ETF.
Okay, rotating out of tech and into energy. What's the justification?
So I think the market has severely mispriced the tail risk over the weekend. This really comes down to spot prices versus forward-looking markets.
Right.
Because spot prices crash on those weekend peace hopes.
Yeah.
But the forward-looking markets, they have to digest the real-time explosions in Iran and Israel's escalating strife.
Right, the reality on the ground.
Exactly. And since our trades execute on a 23-hour lag, I actually expect that fragile 14-point MU to stall. And if it stalls, crude is going higher. So I'm front-running this by locking in our tech profits and moving into energy. Plus, Waller's hawkish pivot is a big risk to tech duration anyway.
Okay, well, I'm actually countering your view entirely.
Oh, really? Let's hear it.
For my trades, I'm going to sell $1,000 of XLE, the energy ETF. I am going to buy $500 of XLK, the tech ETF, and buy $500 of XLU, the utilities ETF.
Okay, so you're doubling down on tech and utilities. Why?
Because I think the momentum heavily favors a crude price contraction. The Hormuz reopening is just too important. If we apply the concept of stale macro data versus real-time pricing, the real-time pricing says the blockade is ending.
Okay.
So I want to rotate those oil profits back into tech to capture that unbreakable AI demand that NVIDIA and AMD just confirmed in Taiwan.
Right, the CapEx cycle.
Exactly. And crucially, I'm allocating to utilities, XLU, because the global power grid is straining. Power generation is the ultimate AI bottleneck right now. And notice I am explicitly avoiding consumer sectors because that 44.8 consumer sentiment print is just dismal.
Yeah, that makes a lot of sense, actually. The grid is the real play. Okay, so we aggregate these opposing views. Our final executed decisions for Tuesday's close will be to sell $250 of XLK, the tech ETF, and buy $250 of XLU, the utilities ETF.
All right, and time for the rapid-fire disclaimer. This is not financial advice. Past performance does not guarantee future returns. Do not copy these trades. This live experiment may fail at any time.
Thank you so much for joining us for this holiday deep dive.
Yeah, thanks for listening, everyone.
Let us know in the comments if you're buying the peace rally or bracing for the next macro shock.